Good afternoon, everyone, and welcome to Butzel Long's webinar, the PPP Update, Audits, Loan Forgiveness, and Changes in the Flexibility Act. During this afternoon's pleasant presentation, please feel free to submit questions to the presenters using the GoToWebinar control panel. Our presenters will answer as many questions as they can at the end of the webinar, time permitting. Also, a copy of this presentation will be made available this afternoon on the webinar event page and on Butzel Long's Coronavirus Resource Center on butzel.com. So with that housekeeping out of the way, I'd like to introduce our panelists today, Bernie Foos, Justin Klimko, and Brett Miller. Bernie?
Thanks, Jonathan, and good afternoon, everyone. Happy Monday. I hope everyone is staying healthy and safe. Wild times to be sure right now. I am still, like probably most of you, working from home here in Michigan. We're entering week 12. We'll see if we can get back to work at some point, but we must go on. So we had a beautiful, awesome, fantastic presentation ready to go last Thursday. The SBA had issued a draft forgiveness application, its final interim rule. We thought we had the clarity for the most part that we needed. We're really going to walk you through the exact process so those of you who have received PPP funds are in the best position possible to maximize your forgiveness. And then late in the day Thursday, the House passed the PPP Flexibility Act, which it's got a lot of good things to it, but consistent with what we've been seeing the last 2-3 months, it changes the rules of the PPP game, including it's likely going to change if it passes the application process itself. So a little bit of a wrench has been thrown into it, but we're prepared for it. We're going to go over it, and we still do think it's valuable for you all to really go through 3 things. One, preparing for a potential SBA audit, whenever that would take place. 2, getting ready for the forgiveness, going through your calculations now, going through the draft application now. And then 3, how the Flexibility Act, if it's passed by the Senate and signed into law, could affect your position and what you decide to do. So really, let's get into it. Again, my name is Bernie Foos. I am a business litigator here at Butzel Long. Justin Klimko is a teammate of mine. He is the president of Butzel Long. He is a business transactional attorney and an M&A attorney. We also have Brett Miller, one of our labor and employment gurus. So 3 different attorneys from 3 different practice areas. All of it kind of mixes together into the stuff that we're going to be talking about. We're going to try to make this process as simple as possible. I know it's been confusing for many of you. So we're going to talk about the PPP program itself and the potential audits. Justin will get into just the loan forgiveness refresher to kind of get you back up to speed quickly. We'll go through some of the changes proposed by the Flexibility Act and how that might affect your forgiveness application, how you determine the forgiveness amounts and the nuances therein. We'll walk through the forgiveness application. Again, that's likely going to change if the Flexibility Act is signed into law ultimately. But I think it'll stay the same for the most part. So it'll be a good exercise for you to start walking through that now. And then, of course, going through the necessary documentation. So again, the PPP program, we've done a whole bunch of client alerts and webinars on this when it first got rolled out at the end of March and the changes that took place through April and into May. Again, the whole purpose of the program was to protect people's paychecks, right? All of you probably remember, hey, don't let your employees go. Don't fire them. Don't lay them off. I visibly remember Steve Mnuchin right in front of the White House saying, hire them back and we'll pay for it. And again, the whole idea was to give these businesses like yourselves a bridge so we get out of this coronavirus situation. You're asking people to shut down their businesses, going through these processes. They didn't want to overwhelm the unemployment system. So the whole thing was designed to protect those paychecks, keep those people employed, get us through this gap, so to speak, so the businesses can kind of pick up where they left off. That was the whole idea behind it. The first round was $340 billion. That was went out like that. The first 2 weeks, that money was gone. They did a second tranche, added over $300 billion to it. But as part of that, people were upset, as you may recall, that a lot of companies who most don't consider to be small businesses, the Los Angeles Lakers, Ruth Chris, Shake Shack, companies that were technically eligible were also taking advantage of the program, swooping in, getting money. So at that point, there was kind of a shame game that went on through the SBA and politicians and TV commentators, really trying to encourage these kinds of businesses, even if they were technically eligible, to give the money back, and for those not to apply for the PPP funds. So in this second tranche, we had expected that the other $300 billion would go pretty fast, but even today, there is still $150 billion available. So if you have not applied for a PPP loan yet and you are eligible and you meet the criteria, you still can apply and you still could receive these funds. But the rules of the game have been changing. That's been the big frustration for many of us is, look, this was the biggest rescue package issued in the history of America. $2 trillion plus an additional $4. Then they added another $1 trillion to it. I mean, just crazy numbers. And throughout this process, they've created this game. You played the game, and the rules have been changing on folks, and it's been frustrating, to say the least. The SBA has consistently updated frequently asked questions on the Treasury website. We're up to number 48 now. 48 FAQs have now been issued by the SBA over the last 2.5 months, trying to clarify and provide guidance to lenders and to borrowers. Some of those questions, candidly, have been conflicting with the act itself and conflict with each other. They've also issued a whole bunch of interim rules, including the application and the forgiveness rule that we talked about that were issued on the 22nd. But again, all of those now are potentially subject to change if this Flexibility Act is ultimately passed. And again, that was passed in the House of Representatives last Thursday, 417 to 1. We think it will likely get through the Senate perhaps this week. I do know that certain senators like Marco Rubio, who championed the first PPP Act himself, has some questions for the SBA. I know Ron Johnson, a senator from Wisconsin, has wrote an op-ed in the Wall Street Journal about changes he'd like to see in the PPP program going forward. So we're not sure what the Senate will try to do, but there is talk that they could get something done this week, and it could possibly be signed into law end of this week or early next, but it remains to be seen, and we'll continue to monitor it. So let's just get into it real quick. The first certification most of you have applied on the application is current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. So those of you who have applied for a PPP loan or have received the money, that was the first certification you gave to the government, is that there's uncertainty and it's necessary. What the heck does that mean? Okay, there is no bright line rule or bright line test that is in the act or has been issued in any of the 48 frequently asked questions. But they have been using this, the SBA, politicians, using this to really scare people into either giving the money back and or even applying in the first place. Okay, it really has a deterrent effect. Most of you, though, have already applied for and likely received the money, and now you're nervous that you might come up with an audit. And here's the concern. How do you prove there was uncertainty such that you needed the loan? I mean, again, there's no bright line test. So it's really making people concerned and frustrated, especially if the SBA is going to come in and audit you. It may well be that you're nervous that they could determine that you're not even eligible for the loan. You got to return it on the spot, or maybe that it affects your forgiveness. So what do you do at the end of the day? Given that there's no bright line rule, and even if you've taken the loan, I think the best thing you can do is document your uncertainty and the need now, okay? We've helped clients and guided them through and kind of shepherded this through, but if you've got a board of directors, certainly it could show up in your minutes where you detail exactly the uncertainty, okay? Your vendors might be out of business. Your suppliers might be out of business. Your customers might be out of business. All these kind of factors of analyzing the situation that creates the uncertainty, putting it into your board minutes, putting it into an email or a written document, supporting your mindset right now. Now it's June 1st, but in May, in April, when you applied, documenting that now, as opposed to waiting later in 2020 or even beyond when the SBA decides to audit you, then you have to go back and try to refresh your recollection. Documenting it now of what was in your mind now is probably the best guidance and advice that we could give. Some of you may have credit lines, some of you may not. Some of you may have parents who have money in terms of parent affiliates and stuff like that. Again, every situation is different, but the important thing and the thing that we've been helping clients with is really kind of papering the record to make sure you justify your decision to have applied for it and to keep the money. And obviously, if you had already made layoffs or you were considering layoffs, but you held off on making those layoffs, those are the kind of things you can put in your minutes or put in emails, things that you were considering that goes to support this certification, the uncertainty and the necessity. With that, the SBA has issued guidance in that anybody who has a loan under $2 million is likely safe from an audit. They are now presuming that you've complied with this necessity requirement. I think they did that in large part because it would be almost impossible to audit every single business who got a PPP loan. So anybody 2 million and under, you kind of get a free pass, but again, the SBA still could audit you for other reasons and rope this back in. Anybody over 2 million, there's no guarantee per se that you will be audited, but you will be subject to review, and they're trying to message that you will likely be subject to an audit. When that takes place, how they would do it, knowing that 40,000 people or businesses have gotten loans $2 million and over, I have no idea how they're going to physically be able to do it, but you should expect and start preparing for an audit and doing that documentation and paperwork now. So with that, let me kind of kick it over to Justin and just he'll walk through some loan forgiveness refreshing points. Justin?
Thank you, Bernie, and good afternoon, everyone. Let's take a quick refresher on the loan forgiveness. There are 3 basic criteria for forgiveness, and we'll discuss each of them at greater length in the ensuing slides. The 3 basic criteria are: first, you must have spent funds on eligible purposes to get forgiveness. You will only get forgiveness to the extent the funds have been spent on eligible purposes. You also must have made those expenditures during the so-called covered period. And finally, you must have made those in certain proportions of payroll costs to non-payroll costs. Now, in addition, there are circumstances which may reduce the amount of forgiveness that would otherwise be available. They are either the borrower has a reduced workforce compared to an earlier period, and we'll talk about how you choose that earlier period, or that the borrower has reduced to the extent of more than a 25% reduction the compensation of any employee who was compensated at a rate of less than $100,000 a year in your previous year. So let's talk about what some of these terms mean. First is the covered period. Again, this is the period during which you must have spent the funds in order to qualify for forgiveness. Under the existing CARES Act PPP loan provisions, that period is 8 weeks. It starts on the day you received the money. So the day you received the money is the first day of your 8 weeks, regardless of when exactly you received it on that day. I know a lot of people had funds hit their account at the very end of the business day, or sometimes even after business hours. That still counts as your first day, and you count your 8 weeks from then. The Flexibility Act would expand that period from 8 weeks to 24 weeks after the loan funding, or to December 31, whichever of those 2 things comes first. So either 24 weeks after the loan or December 31 would be the covered period. One thing that this 24 weeks does is it sort of eliminates the mismatch that existed originally, because if you will remember, the amount of your loan was initially calculated based on 2.5 months of payroll costs, or 10 weeks of payroll costs. So you borrowed 10 weeks of payroll costs, but you were only given 8 weeks to spend it. And so there was going to be always a gap of sorts, even if you kept all of your workforce and paid them exactly what you had paid them before, you're going to have a gap between the amount of forgiveness and the amount of the loan. And this 24 weeks would eliminate that. One thing that's not clear, and I know people have asked this question, is whether it's an either or. Is it either, because the CARES Act does say that borrowers with existing loans may choose 8 weeks. What's unclear from the Flexibility Act, at least, is that whether you can choose a period between 8 and 24 weeks. You would think that would be permissible once you've spent your money, that you can then apply for forgiveness, but it's not clear from the text of the Flexibility Act whether you can choose a period within those two parameters or dates. Now, we mentioned the covered period being 8 weeks from the date you get the loan, but under SBA guidance, and this is created by SBA rulemaking, this is not in the statute, you may choose an alternative covered period if you have a pay cycle either bi-weekly or more frequent. So obviously that would be bi-weekly or weekly. So if you have a monthly or semi-monthly pay cycle, you are not eligible to choose the alternative covered period. If you are, you may choose to have your covered period, rather than starting on the day you receive the funds, to instead start on the first day of your first payroll cycle after you receive the loan, and continue for 8 weeks after that date. And this helps borrowers more easily sync up their payroll cycles with their covered period. Now I'm going to ask Brett very quickly to comment on what happens to borrowers who have both a biweekly period and a monthly period, or something that's less frequent. We've heard about several employers who, for some of their staff, pay biweekly, and for others pay on a less frequent cycle. But Brett, do you want to comment on that quickly?
Sure. Yeah, from a labor and employment standpoint, you're looking at probably using the alternative covered period for your biweekly or more frequent employees, and typically this is going to be sort of your hourly workforce. Might be biweekly. Some companies then would pay salary on a monthly basis, and the regulations simply are not clear on how you mix and match on that, because the form isn't designed for sort of these two periods. But the best you can do is sort of trying to match up and sync your payroll as much as possible using an alternative period for your bi-weekly or more frequent, and others, you simply are trying to line up the salary folks particularly as best you can within that period.
Okay, thanks, Brett. Now, as we said, you also must spend, in order to get forgiveness, you must spend the funds on certain types of expenditures. And the language in the statute says you spend them on costs incurred and payments made during the covered period. And Brett is going to explore that a little bit more in a minute. But the eligible types of costs you see on this slide, there are 4 types listed, but I want you to think of them in 2 separate buckets. The first bucket would be payroll costs, and the second bucket would be the 3 things below on the slide, which is mortgage interest, rent, and utility payments. The reason I want you to think about it that way is because when we start talking about the 75% rule, you're going to see that those 2 buckets that's the conceptual approach to determining the 75% rule. Note that with respect to the latter 3 expenditures, you only can get forgiveness for those obligations that were in existence prior to February 15th of this year. So while you're permitted under the Act to spend funds on these types of things, even if they were created after February 15th, you may not get forgiveness on them. Congress essentially said, we will give you forgiveness only for existing obligations, not for new obligations that you go out and create. I'm going to ask Brett to get into payroll costs more granularly and explain how those are determined and what the regulations are with respect to those. Brett?
Sure, thanks. So as you mentioned, the first bucket for forgiveness that companies need to consider are their payroll costs. And the regulations and the act do have certain definitions of what that means. So payroll costs under the CARES Act include compensation, salary, wage, commission, cash tips or their equivalent. Now it's up to 100,000 annual rate. So it's someone earning at a rate of up to 100,000, and anything above that is we're only looking at below that number. We've had a lot of questions then about, okay, well, salary, wages, commissions, that's all great, but what if I have people who are laid off, they're on unemployment, they don't want to come back? What if I have people who are afraid to come back to work because of COVID or particular concerns? Can I pay them hazard pay? Can I pay them a bonus? Now, what about people who I don't have work for because I'm shut down by a stay-at-home order and they're furloughed? Can I pay them, or do they have to be working? And the regulations have clarified that yes, in fact, you can pay people to stay home as long as they're on payroll. If they're afraid to come back to work, you're allowed to use hazard pay or bonuses, and these are all potentially forgivable payroll costs as it's defined. So that that doesn't necessarily penalize you, especially because a lot of companies are having to pay what quote unquote hazard pay or bonuses. Traditionally also, other payroll costs are included, like vacation, parental, medical, or sick leave under a company's policies or payroll costs that can be forgivable. I caution employers, though, that the CARES Act specifically excludes payroll costs for those who have to utilize the Families First Coronavirus Response Act leave. FFCRA leave for medical leave or COVID-related leave is paid for through a separate government reimbursement mechanism, and you can't double dip. So most payroll companies have those coded for the type of leave, but your traditional PTO, sick time, as a payroll cost, it's potentially forgivable. The same is true for severance payments, healthcare benefits, and state and local taxes assessed on employee comp is all included in payroll costs. An open question remains short-term or long-term disability premiums for employees. A lot of the payroll companies have kind of come out and said those are included as payroll costs, but so far the regulations have been silent. So a lot of the payroll companies, when you request information on your benefit costs to use in your forgiveness application, are including short-term and long-term disability. So that's just something that people should keep an eye on because that is an open question that we currently have.
Hey, Brett, could you comment quickly on 1099 expense?
So 1099 is not going to be a payroll cost. In other words, for a company that has 1099 workers, it applies to W-2 workers. So if you are making payroll, it's got to be payroll for your W-2 pay to your employees. I've seen some companies swapping out contractors and hiring them on directly as W-2 employees to make sure that they have this. Now, the CARES Act does state that, for PPP purposes, if you are a gig employee, if you are a sole contractor, if you're an Uber driver who's normally 1090, you get 1099, you can get CARES Act and pay yourself, but it is not for employees who are otherwise who would be W-2. You have to use it for those employee payroll costs.
Brett, what if question for you? What if you had, we got a question here, I'm just gonna ask it now though. You had W-2 employees, that's how you calculated it for your PPP loan purposes. Then you let them go, then you get the loan, and this client, at least, they brought them back as 1099 employees. I don't think that if you brought them back as 1099s, I don't think you could use that money and get that forgiven. You'd have to bring them back as a W-2. Would you agree?
Correct. And as we'll talk about in a moment, from a forgiveness standpoint, it would count against your head count. So, not only is the expenditure not going to be a payroll cost, but it's not going to count as the employee that the company would want. And we can talk to clients about some of the specifics on strategies if something like that has happened, but there's a lot of inherent legal risk beyond CARES Act in swapping people between W-2 and 1099 or for the same job position, because Department of Labor audits, wage and hour issues, overtime. It can become a huge labor and employment legal headache. And we're happy to talk to clients about that. But I mean, it's a great point, because it really draws the distinction between 1099 workers. What you pay them are not going to be payroll costs. They're not going to be forgivable, and they don't count as your employees during that time. So that's an important distinction, because again, as we see from this next slide, there are payroll costs that have to be paid versus incurred within this covered time period that Justin mentioned. And payments made during the covered period that could be forgiven include the payroll costs that we mentioned. But Justin, I know you've had a lot of questions, or you've dealt with issues of other costs that may not be quite so clear as whether they've been made or incurred during the covered period, like prepayments. What's your read on that?
Well, the statute itself says that forgiveness is available for costs incurred and payments made during the covered period, eligible payments. Some people have read that to mean costs incurred and paid, but that's not what the language says. I think what it says is that you get forgiveness for costs incurred during the covered period, and you get forgiveness for payments made during the covered period. Now, that raises the question of whether prepayments are allowed. Could you, for instance, say, I'm going to prepay my next 2 or 3 months rent in order to get included in my forgiveness costs? Now, remember, there's a 25% limitation in the first place, which Brent will discuss in a minute, but there's nothing specifically in the statute that says you can't do that. The only thing that's not allowed in terms of prepayment is mortgage interest. And it's clear that, as Brett will elaborate further on this slide, that amounts that are incurred during the payroll period can still be counted even if they're not paid, as long as they're paid by the next due date.
That is sort of a helpful common sense clarification. I think we got from the government on these. As you mentioned, this definition of incurred, we had people really wondering, well, what happens for things that are coming due at the very end of my covered period? Do I have to move forward payments to line up? And the government has said, for like the alternative covered period Justin mentioned, compensation earned during that covered period can be paid on the next payroll date. Same with the non-payroll costs, those rent, utilities incurred during the covered period, but then you're billed and you get the payment on the next billing cycle. And that's acceptable. That works. That's allowed. Rent, of course, often is prepaid, for the coming month. But utilities, things like that, may fall outside your covered period, but you're still paying for what you were billed during that time. So it's an important distinction. Payroll costs kind of go along a similar route. So payroll costs paid, again, more common sense, on the day paychecks are distributed, or for direct deposit, the day that ACH transaction originates. And again, that makes sense. Okay, payroll costs are paid right when that money is going out. Payroll costs incurred is fairly standard for employees who are actually working or who have been working during your covered period. Essential employees, for instance, the day they earn the pay, their work day, is the day those payroll costs were incurred. For those who have stayed home or you haven't had work and they're furloughed, or you're paying them under PPP to stay home, you really have a choice as a borrower of a schedule, but it's typically their normal work day. So 9 to 5 employees, you would even if they're not working for you, but you're paying them, you would use that normal schedule. That's the easiest approach. And Justin, you've mentioned the 75% rule. We've talked about that a little bit. 75% of those payroll costs, or for the amount to be forgiven, have to go to those payroll costs. So in other words, not all companies are going to put 100% of the PPP money they get to forgiveness, but whatever amount they want the government to forgive, 75% of that amount has to have been spent on payroll costs that we mentioned. The non-payroll costs, that up second bucket, 25%. But that can be, as you mentioned, there can be a little trick to that, Justin, because you got 10 weeks worth of loan to pay out in 8 weeks. So companies have to kind of do the math and make sure they're hitting this number. Under the Flexibility Act, if this passes, this is going to change to a 60-40 proportion. 60% must be spent on payroll. But there's I think a pretty drastic distinction in the Flexibility Act. As I mentioned, the 75% under the current rule is only 75% of the amount you want forgiven applied to payroll costs. But as I read the Flexibility Act, you have to spend 60% of the entire loan amount on payroll costs. And Justin, I think you've looked at this. What do you think about that provision?
Yeah, so the 75% rule is not in the statute. It's created by the SBA. And as you say, Brett, the rule is simply that whatever your forgiveness amount is, 75% of that has to be payroll costs. So you start with your payroll costs, you figure out how much that is, and then your additional amount can be no more than would cause the total amount to be 25% of non-payroll costs. So you can divide the 75% by that amount. The Flexibility Act approaches this differently. It does say that the ratio is 60-40, but the language seems to suggest that you get no forgiveness at all unless you have spent at least 60% on payroll costs. So that's a different approach than the SBA guidance on the 75% rule, if that in fact is the way it's going to be interpreted. And Bernie mentioned Marco Rubio asking for some clarification before the Senate votes, and this is one of the things he asked about. Is it in fact the case that unless you spend 60% on payroll that you won't get any forgiveness at all? Because that's not the way the 75% rule works.
Right, and that's more confusion when we're trying to get clarity out of these rules. Likewise, confusion on limits of forgiveness on the workforce reduction. Okay, so we do have some clarity on this, and of course, Flexibility Act could change this. But the amount forgiven will be reduced if a borrower reduces its workforce during the covered period. Again, this law is designed to maintain headcount. The purpose is you get this money from PPP, you keep people on payroll, you don't lay them off, you don't cut pay or FTE, and then it's supposedly forgiven. But for those who do cut headcount during the covered period, there's a pro rata reduction. The actual application for forgiveness has a worksheet and walks companies through in great detail the actual math on this. But very briefly, what you're doing is comparing your average monthly FTEs during that 8-week covered period compared to average monthly FTEs for your choice of 2 earlier periods from February 15th to June 30th, 2019, or January 1st to February 29th of 2020. Either of those would be the denominator in this calculation. And again, if your FTEs essentially match up with those earlier periods, you're maximizing your forgiveness. If you have fewer FTEs during the cover period than you had previously, it's going to cut into your forgiveness on a pro rata basis. We had a lot of questions about what FTE actually means, because it does talk about monthly FTEs during these measuring periods. And the new application and regulations clarify that you're looking at a 40-hour work week. So full-time equivalent employee is someone who works 40 or more hours a week. If they work 40 or more, that's a 1.0. You then have a choice as an employer to calculate employees who work under 40 hours. So you can do the math and get the average hours paid for an FTE equivalent or a full-time equivalent. So if someone's working 32 hours, you can say they're a 0.8 FTE. But borrowers also have a choice to simply count employees who work less than 40 hours as a 0.5. So you'd have 1.0 and 0.5s in that case. And that may make more sense for employers who have contingent workforces or a real variable hour workforce. But really, you can play with the numbers and see what works best, because you do have the choice, but that's how you would calculate full-time equivalent employees. But like everything else in this law, there are other rules that go along with this and some other wrinkles for employers to consider. Justin, what other exceptions are there?
Well, the SBA has come out with a new exception because employers were saying, listen, I am trying my best to maintain my payroll and to retain my workforce, but they're not cooperating with me. I had to lay some of them off and I want to bring them back, but they're making more money on unemployment than I can pay them. And they're saying no. or others may be resigning for that purpose. The SBA came out with guidance that said, if you laid off employees and then offered to rehire them for the same salary and the same hours, or you reduce someone's hours and then offered to restore their hours, you won't take a hit on your forgiveness calculation for those people. You will count them as though they were still employed. You won't have to take a reduction. Same is true for employees who are fired for cause, for employees who resign, or for employees who themselves request a reduction in hours. The SBA's rationale is that employers shouldn't be penalized for events that are caused or initiated by employees and in fact are out of the control of the employer. Now bear in mind, you'll have to document the fact that these things are true. So if you offer to rehire and it was refused, you're going to have some documentation of that. It's not just word of mouth. The Flexibility Act would codify this to some extent. It says that the inability to rehire employees who were employed on February 15th and the inability to replace them with similarly qualified employees by December 31st, again, will be an exception to that workforce reduction. And it also creates a new exception for employers who say that they're unable to return to the same level of business and therefore have the same level of workforce that existed before because of their compliance with health guidelines, such as distancing requirements, limited capacity in restaurants, things like that. Now, hopefully the new, if the Flexibility Act is passed, that these new rules will dovetail with the former guidance from the SBA, because you'll see, as you can see, these new rules in the Flexibility Act don't mention, for instance, employees who resign. We have no reason to think that the SBA guidance won't still apply after the Flexibility Act is adopted. If in fact it is, because it's merely an amendment of the existing act, but I guess that remains to be seen to some degree. Now, as we mentioned, there's also a second quality or factor that might result in reduction of the amount that can be forgiven, and that relates to reducing the compensation of employees by more than 25% during the covered period when you compare that to the previous quarter. Now, it's important to note that this only applies to one group of employees. And that's employees who were not paid during any single pay period in 2019 at a rate in excess of $100,000 a year. And so, you know, that raises some questions. If you had an employee, I used this in the earlier webinar, if you had an employee who was making $1,000 a week, but in the last pay period last year, you gave them a $2,000 bonus, in that last pay period, they would have received $4,000 if it's a semi-weekly or twice-a-month pay period, and that might be a rate in excess of $100,000. So do you not count their reductions? Not clear. The language seems to say that. Brett, you might want to comment briefly on how this is calculated and the fact that it's not an aggregate calculation.
Yeah, that's a great point. For when you're applying for your forgiveness, I mentioned on your FTE headcount reduction, it's a pro rata, you know, kind of total number crunching. But with the compensation reduction, it's a dollar for dollar reduction calculated for each individual employee. It's not an aggregate. So when you're filling out this application, you're looking at each employee for those earning at the rate less than 100,000, and if they hit 25% of a reduction in their pay, everything over that is a dollar for dollar reduction in your forgiveness. And so again, that can really throw a wrench into how you're calculating this and affect your forgiveness amounts.
Justin, let me ask you this, and maybe Brett too, but let's just give a quick example. If you've got somebody who's making over 100,000, they made, let's say they made 200,000 in 2019, Justin. Certainly for the application purposes, you can bring them and use them up to the 100K cap number, but could you reduce them down to 50 grand or even zero and not have it affect your forgiveness on the whole 75-25 thing?
I think the answer to that question is yes, you could. If you look at the loan forgiveness app, and we'll talk about this a little bit more later, but on the loan forgiveness app, there are two different tables for compensation. You list one table where you list all of your employees and their compensation who made below $100,000, and then a second table for everyone who makes $100,000 or more. And that first table also has a column for computing this compensation reduction. The second table has no column for that because it doesn't affect this compensation reduction. So ostensibly, you could take people making more than $100,000 and take them to zero, and it would not limit your or reduce your compensation. I'm sorry, reduce your forgiveness based on the compensation reduction. Now, having said that, remember, we're talking about limits on forgiveness. You've got to get the forgiveness in the first place. So to the extent that you're reducing people's pay, you're reducing the raw material for your forgiveness because it's based on your payroll costs during that period and your other costs. So if you're reducing your payroll costs, you may be have some flexibility in whether or not you get hit with these reductions, but you still are not creating the payroll costs that go into your forgiveness in the first place.
And Bernie, it's also a bit of a trap because you have to remember your FTEs. And so I had a lot of clients who at the beginning of the COVID crisis cut salaried workforce, to your example, making over 100,000, cut their work week and their salary, say, by 40%. So their work week dropped 40%, their salary dropped 40% to try to right size things. Now, yeah, for 100,000 compensation reduction analysis, that shouldn't matter because they're over 100,000, but they're still, you still have to worry about the FTE number being reduced. So there's a lot of nuances to this. That is why we always recommend call your lawyer, talk to your accountant when you're going through this.
Okay, so there are for these reductions that we talked about, the workforce reductions and the compensation reductions that may limit your forgiveness, there actually are some exceptions to that. So the SBA has said that, I'm sorry, not the SBA, but the CARES Act itself says that with respect to the staff reductions, if you eliminate the reduction in the number of FTEs by June 30, then that won't count against you. You can count those people as though they were employed for that whole period. And similarly, if you eliminate the compensation reduction by June 30, then you don't have to count that salary reduction as a reduction of your forgiveness. Now, Brett, maybe you can comment on the limited period during which you measure that to begin with.
Yeah, there's the first question we ask is, when the question is, can we bring everybody back by June 30th or the Flexibility Act December 31st and be fine? But the regulations actually specified that people who were laid off between February 15th and April 26th are the population that you're looking at to be restored. So if they were laid off outside that period, this sort of safe harbor doesn't apply. And as I know you were mentioning, there's still the question of making sure that you hit the payroll cost percentage, 60% under the flexibility or 75%, if you're going to rely on this safe harbor.
Now, the SBA has also said, and this is by rulemaking, that you won't get hit twice for the same reduction. So what does that mean? If you have an employee that you have reduced from a full-time employee, you reduce their FTE status. Let's take, for example, an employee that was a full 1.0 FTE prior to the period, and you reduce them to 0.5 during the period. Obviously, you will have reduced their compensation also. And there's nothing in the act that coordinates those two things. So in theory, you could be getting a reduction to your forgiveness for the fact that you've reduced FTEs and also a reduction based upon the fact that they're making less money. But the SBA has said, no, we're not going to hit you to the extent that the decline in compensation is attributable to the FTE reduction. So if in our example, you reduce the 1.0 FTE to 0.5 and also reduce their pay by half, then you would still have to calculate the FTE reduction, but you would not have to account for the pay reduction in the forgiveness situation. But if you reduce their compensation by more than 50%, then that differential you would have to account for. So there is some safe harbor here to prevent a double penalty for exactly the same thing. Let's talk briefly about the forgiveness application itself now that we've been through these topics. The forgiveness application is available online. It was made available by the SBA on May 22. As Bernie indicated, it's going to have to change if the Flexibility Act is adopted, because as currently structured, it incorporates the 75% limitation. It has the June 30 dates in it, etc. So while this form is available, it's not going to be the final form if indeed the Flexibility Act passes, as we all expect it will. However, we would expect that the form of the act, the basic outline of the act, will probably stay intact. It'll change some particulars, but the way it's set up is probably the way it will continue to be set up. So what does it consist of? There's a set of instructions that tells you how to calculate and figure out. There's an actual forgiveness calculation page or form that you fill out. And there are a couple of schedules and worksheets that support that. So as I said earlier, it's like being in the 5th grade math and having to show your work. You have to show your work to show how you got to the forgiveness amount that you got to, and that's what those schedules are for. The basic structure is that you list your payroll and your non-payroll costs. And as I said, there are 2 tables for compensation. You list the adjustments for the salary or wage reduction that we talked about and the workforce reduction. And then you fill out the Schedule A to support that, and you have to list the compensation. You have to list all the employees on one of those 2 tables in the schedule and their compensation. Now, Brett, let me ask you this. Does this mean that for my highly compensated employees, I have to disclose their entire compensation?
No, the regulations don't say that, although it's a great question because it can be confusing. You're still only looking at that 100,000 number. So when you go to fill this in as a company, you're not writing down, oh, so-and-so made 700,000 or 500,000. I mean, you're capped at that 100,000. So really all you're looking at is the prorated amount of your 100,000, the the 15,385 number is what you're going to be filling in that section. So yeah, it's not a total highly compensated request that you list everybody's salary. It's really just that prorated number.
And just if you're wondering where 15,385 came from, that's $100,000 divided by 52 weeks, multiplied by the 8-week covered period. And obviously, again, the instructions for that table will change if the Flexibility Act changes and increases the covered period. 24 weeks would be about $46,000. So it'll make a pretty significant difference.
And Justin, we had a question that sort of relates to this. That can an owner of the company be paid under PPP if they're already on payroll? And so presumably we're talking about someone over 100,000 when you look in that table. And does that cap apply, or how would you handle that if you were the owner of a company and already on payroll?
Well, you can't double dip. The act, it depends on the structure of your business, so it's hard to give a blanket response to this, and I'll ask Brett, you or Bernie to comment further if you'd like to. But there is language in the act that says for owners of businesses, they should not include themselves in, if they're on payroll, they do include themselves, but otherwise they apply separately. And the same thing for independent contractors. So it depends on the structure of the business. And you can elaborate on that if you'd like.
I agree with that. If they're W-2ing themselves and they're employed, yeah, I think they're good up to the 100K. But if they're not and they're 1099 or it's a different structure, it wouldn't count.
Yeah, that's how I read it too. If you're W-2, if you're on payroll, you're legally an employee of your company. Yes, but like you mentioned, Justin, there is that 852nd cap that you're looking at. So it may end up being a moot point depending on what their payroll number is.
Okay, a couple more things to finish up on the certificate, excuse me, on the application, and then I'm going to flip it back to Bernie. There are certifications required in the forgiveness application. You remember Bernie talked earlier about the certifications that were in the loan application, including the necessity certification. There are similar type certifications in the the forgiveness application, and like the loan application, any fraudulent certifications presumably are subject to prosecution. You have to certify that you've used the funds for permitted purposes, that you've properly calculated the forgiveness amount, etc. There are also some documents that you're going to have to submit when you apply for forgiveness or to maintain. there's actually three categories. There's documents that you actually have to submit to the lender, because the lender is the person, by the way, to whom the forgiveness application is made. The lender makes an initial determination and then recommends to the SBA. So it gets submitted to the lender, and that includes things like bank statements or third-party receipts or payroll reports, cancel checks and the like that verify expenditures. There's other types of documentation that you have to maintain and provide on request, and those include things like support for your offers of reemployment, to the extent you've terminated people for cause, documentation of that, resignations, support for the loan calculation itself and the loan amount originally, those type of things you have to maintain. And then there's a third category of documents that you may voluntarily provide. You have to retain all these documents for a period of 6 years after either the forgiveness or the repayment of the loan. And you have to permit the SBA to access those documents. So I now want to go back to Bernie and ask him to comment a little bit about the tax consequences of forgiveness.
Sounds good. Real quick, folks. At the outset, back in March into April, a lot of you probably thought and saw this in the act that forgiven amounts, let's say you get a loan for $1 million or $2 million, do not constitute cancellation of debt income. So if you got $1 million or $2 million PPP loan, whatever the amount was, people were kind of licking their chops thinking, oh my gosh, not only isn't this going to count as income, so I'm not taxed on it, I get to use the money for expenses. So it's almost a double whammy of, is this too good to be true? But sure enough, the IRS has now stated that in accordance with existing principles, the money you use that PPP funds for will not be able, you won't be able to deduct those as expenses on your tax returns as well. And look,
if they are forgiven.
If they're forgiven, correct. So
yeah, if you pay tax on it to begin with, then you don't get to deduct the expense.
Correct. So you don't get that, it's not even income, and you don't get to enjoy the double whammy benefit of deducting that for expenses as well. There is some talk out there that Congress may change that. I haven't seen anything of substance in terms of getting traction on that, and I don't anticipate the IRS would separately do something on that. If they do, fantastic for all of you out there, but I guess I would not expect that. Secondly, most of you have likely taken, if you've gotten the PPP, you're also taking advantage of the payroll tax deferral. That's a 50-50 split between 21 and 22 in terms of that amount that would be due. It's not canceled, of course, it's just deferring the actual payment. Right now, you can still do that, but if you were to apply for and receive forgiveness in July, August, or September, once you get that forgiveness, if it was granted, you don't get to take advantage of that payroll tax deferral any longer. That said, if the Flexibility Act is signed into law, that would eliminate this restriction. So not only could you get the forgiveness, you could continue to take advantage of the payroll tax deferral through the end of the year. So what happens, let's say you go through an SBA audit or you go through the forgiveness application, you've got some money left over, or heaven forbid, all of it's not forgiven. What happens at that point? As of right now, it converts or stays as a 2-year loan at 1%. You have a 6-month deferral from the date that you received the loan, okay? But any remaining amount that isn't forgiven would convert into that 2-year loan at 1%, and that 6-month deferral will be in the process. Again, those of you who have received loans have likely signed notes and documentation evidencing that this is the interest and the term on the loan to the extent it's not forgiven. The Flexibility Act, though, does say for new loans, the term will be 5 years. 5 years. Now, again, that's for new loans. That said, borrowers and lenders may modify existing loan terms to conform. So basically what that means is if this Flexibility Act is signed into law, folks, I would encourage you to talk to your bank, and it should be an easy, quote, should, end quote, renegotiation, modification to the existing terms, taking it to 5 years at that 1% mark. Another thing that's on this, though, if that Flexibility Act was passed as it is right now, there is this weird quirk about when the deferral would actually start. In the act, it says the deferral lasts until forgiveness amount is remitted by the SBA lender. That throws a bunch of wrenches into it. I don't want to get too deep into it, but that could be a point of additional confusion if this act stays the same and is passed into law. So we got a few minutes left here. I want to get into some rapid fire Q&As right now while we have the time. That said, offline, our entire Butzel Long CARES Act assistance team is ready to help. So Justin, myself, and Brett are here, can definitely answer questions and guide you offline. Just reach out to us via email. We also have other members of the team listed here in different departments, tax, nonprofit, healthcare, all those kind of things that can jump in and help you as you need. Again, we're here to help on specifically the audit and papering that record, so to speak, and preparing you for that audit. Certainly the maximizing loan forgiveness as you go through the process. We've been helping clients review their documentation, review their application, kind of guide them through and handhold them through the process as best we can. And then certainly as the law changes, as the additional guidance is issued, we'll issue alerts and possibly do future webinars. So keep following us on social media and the website. So let's jump into a few questions real quick. Justin, let me kick this one to you. Here's the question. Our landlord provided a deferral of our April rent. Can we now claim it and the May and June rent as being part of the covered period? Let me first take a crack at that. In that I've had a bunch of clients, they've gotten some relief from their landlords, but thereafter they got approved for the PPP loan. What they ended up doing was just sticking with the original lease terms, paying that money or paying it after the fact, using that as forgiveness, and then taking that free rent and pushing it past July 1st so they could take advantage of it separate from the PPP funds. I think you can do it. Justin, do you have any thoughts on it from your perspective?
So I think this gets back into that paid versus incurred question. In theory, if you pay it during the period and it's an eligible cost, the fact that it was not incurred in that period could be support forgiveness. Again, there's no direct guidance, from the SBA on that question, but if it's paid during the period and it's an eligible cost. Now remember, if you're talking about rent, you're talking about something that falls in the 25% bucket. So it can't be more than 25% of the total forgiveness cost. So if you're adding another rent payment to your forgiveness costs, that may cause your proportions to get out of whack. But again, the 25% may become 40% if the Flexibility Act passes.
That's right. Brett, question for you. This person has staff in furlough right now. They're planning on bringing them back by June 30th. I think the question will be, when did they get their PPP loan money? But how long do they need to remain on the payroll, Brett, if they bring them back before they can be terminated?
So yeah, I mean, a lot of this depends on when they got their money, if they're going to hit the 75% threshold for forgiveness. But that is a kind of common issue, is whether after your covered period, in other words, you've gone 8 weeks, you have utilized 75% under the current rules for payroll costs, and now you're going to apply for forgiveness. What do you do with your employees after that? You've used the money for the stated purpose. And I at that point, there's nothing in the law that says you have to keep people on. If you have to do layoffs, you have to do what you have to do for your business. You've utilized the 8-week covered period. The statute looks at that for your forgiveness amount. So there's no requirement to keep people on after that. Of course, if you elect if the Flexibility Act passes and you elect a 24-week period, that changes the time period you'd have to keep people on payroll for your forgiveness. But otherwise, there's no special rule that says if you've taken our loan, you have to keep people employed beyond your covered period for X amount of time. You got to do what you got to do for your business.
But Brett, I think you might want to qualify that by saying, even with the 8-week covered period, if your 8 weeks goes beyond June 30, you got to keep them on at least to the end of your covered period.
No, correct. Yeah, I mean, whatever, yeah, your covered period, that 8 weeks is going to be key. So June 30 may have some magic if you're taking advantage of the safe harbor, but you don't want to, cut them off during your covered period anyway, and then hope for the best. No, that's a great point, Justin, because you want that you want that period to match up.
We are at 1 o'clock, but I think we can go over a little bit and answer one or two more questions. Justin, let me pose this one to you. You and I have actually internally debated this. Here's the question. Do short and long-term disability insurance premiums paid by the company count as benefit payroll costs? Now, look, we have seen the largest payroll provider in the country, ADP, has issued their own FAQs, and they've made the decision on their end that short and long-term disability insurance premiums do count as payroll costs. But Justin, I'll turn it to you. That's not anywhere in the actual law itself right now, right?
That's correct. I have not been able to find any support for that position. Health insurance, yes, but disability, life insurance, I see no support in the statute or this guidance for saying that that is includable in forgiveness costs. So as Brett says, as Bernie says, we know that some payroll providers are saying, well, we're going to include that in what we're sending you in terms of the documentation or the support, but I don't know where that comes from, and I don't think anybody on our team has been able to find any support for that.
Yeah, now I'll just echo that from a legal standpoint. Again, we can't give you specific legal guidance that is accurate. Now, if you could find costs, and if they extend this period from 8 weeks to 24 weeks, to me, you're going to have, if they extend it to 24 weeks, you're going to have additional funds available or different expenses that definitely do fall under the forgiveness. Okay. And this probably won't be an issue if that actually ended up happening. That said, if you got some leftover money and you're going to rely on ADP, I mean, you can certainly try, but if you're looking for a confirmation that it's legal, we just can't give that to you right now, and the guidance hasn't been issued. Let's do one more question, and then certainly if anybody else has others, you can reach us offline. Brett, let me do this to you. Payroll providers have been helping with FTE calculations, like an ADP. How do we calculate the FTE amount for the base periods if our payroll periods don't match those exact dates?
So, well, and Justin, you might want to chime in on this. The alternative covered period was supposed to sort of make that easier because payroll companies are going to be providing that data based on sort of these payroll periods. And in theory, the alternative covered period allows you to align those dates if you have the biweekly or more frequent. And that is really supposed to be the easiest way to do it. So you've saved that headache. And Justin, if you have any other thoughts on that.
Yeah, I mean, again, there's not specific guidance on, what supporting documentation you use. I mean, you may be able to use, your payroll providers are one source of the support, but you've got your own records, your own employment records that can show, if there's some mismatch between the covered period and what you're reporting from your payroll providers. So I think, it would be a matter of just providing additional documentation. Those people remained on your workforce and the like, and we're not terminated. It talks about the reduction talks about average FTEs during that period. The guidance doesn't seem to really focus on the fact that they're talking about average FTEs, but it's still a matter of doing the calculation and finding the necessary documentation. Payroll providers are not the only source for support for that.
All right, one final question, and this deals with an audit. This person got a $2.2 million PPP loan. They want to know if they can return the 0.2 of it or a little bit more so it gets them under the $2 million threshold such that it could decrease the possibility of an audit. Justin, I don't know your thoughts. From my perspective, look, the loan was issued at 2.2. You got the money. That's what's been reported to the SBA. That to me would make you over that $2 million mark. Yeah, you could return the money and try to get out from the ability to get audited. But from what I've seen with the guidance and everything else, I don't think returning just a portion of the money is going to get you in the clear and avoid an audit altogether. It's at least my perspective.
So on the application form, there's a specific box you have to check that says my loan was 2 million or more. And it doesn't say anything about what your, sort of remaining balance is. So I think, I would be reluctant to tell someone that they could give the money back and then not check that box. I think that box is going to be the flag for determining, who's going to be audited. So it's more than just, how you think about it. You have to make a specific representation on the form, the forgiveness form, as to whether or not your loan was in excess of 2 million.
All right, so we're a little bit 6 minutes over, but I think it was worth it to answer some of these questions. Thanks to everyone out there who joined the webinar, and we know it was detailed, it was granular, it's confusing, it's frustrating. We're doing our best, obviously, to try to make it simple and guide clients and folks like yourself through it. Again, if you have questions offline, you can reach out to Justin, myself, or Brett, or certainly anybody on our Butzel Cares team, and we'd be happy to work with you and guide you and help you as best we can. But thanks again for your time. Hope you guys enjoy the rest of your Monday and the rest of the week. And as the law changes, we'll be updating and providing alerts and guidance accordingly. Thank you so much.